Hey guys, good morning, good afternoon, good evening, wherever you are. It's CJ Investing. Welcome back to my channel. And today I'll be doing a video on why you should invest in the stock market in 2023. And so I'll be taking a look at this article on themotleyfool.com. So why is it important to invest in stocks? So I'm gonna read this article and then I'm gonna give my thoughts and my own reasons for investing in the stock market. So a look at some pros and cons of investing in stocks. The stock market has created an enormous amount of wealth over the years. Investing in stocks on average, the S&P 500, which includes 500 of the largest U.S. publicly traded companies, has returned 8% to 12% annually. Only $10,000 invested in the stock market 50 years ago would have grown to more than $380,000 today. Wow. However, be aware that the stock market doesn't go up every year. The S&P 500 typically falls 3 out of every 10 years. Some drops can be quite brutal, and this level of volatility is not for everyone. But if you can manage your fear, stocks have the potential of earning significantly higher returns than other investment options over the long term. Benefits of investing in stocks. There are many benefits to investing in stocks. 7 big ones are: number 1, the potential to earn higher returns. The primary reason most people invest in stocks is the potential return compared to alternatives such as bank certificates of deposit, gold, and treasury bonds. For example, the average stock market return has been about 10% annually since 1926. That's a long time. Long-term government bonds have returned 5% to 6% annually during the same period. The ability to protect your wealth from inflation. Stock market returns often significantly outpace the rate of inflation. For example, the long-term inflation rate has about 3.1% annually since 1913. That compares to a double-digit annual return from stocks. Stocks have been a good way to hedge against inflation. Number 3, the ability to earn regular passive income. Many companies pay dividends or a portion of their profits to investors. The majority make quarterly dividend payments. Although some companies pay monthly dividends, dividend income can supplement an investor's paycheck or retirement income. Okay. Number 4, the pride of ownership. A share of stock represents fractional ownership of a company. You can own a tiny slice of a company whose products or services you love. Number 5, liquidity. Most stocks trade publicly on a major stock exchange, making it easy to buy and sell them. It also makes stocks a more liquid investment compared to other options such as real estate investments that you can't quickly sell. Number 6, diversification. You can easily build a diversified portfolio across many different industries through stocks that can help you diversify your overall investment portfolio, which could also include real estate, bonds, and cryptocurrency, reducing your overall risk profile while improving returns. Number 7, the ability to start small. Thanks to $0 in commissions and the ability to buy fractional shares with many online brokers, investors can begin purchasing stocks with less than $100. Risk of investing in stocks. Now that we've covered the benefits of investing in stocks, we'll look at some of the risks or the drawbacks. The biggest risk of investing in stocks is stock market volatility. On average, the stock market declines 10% from its high about every 11 months, 20% around every 4 years, and more than 30% at least once per decade. Because of that volatility, investing in stocks isn't for everyone. Here are a few reasons why you might not want to buy stocks. You can't stomach the thought of a 10% or greater decline in your investment. You'll need the money within the next 3 to 5 years for a down payment on a house or some other large planned purchase. You're retired or nearing retirement and need a fixed income stream more than the capital appreciation potentially offered by stocks. Beyond volatility related concerns, there are other reasons to avoid stocks. You have a lot of high interest rate debt, like credit card debt. Paying off this debt can often yield higher returns than buying stocks. You don't have an adequate emergency fund. Having enough cash on hand to cover an emergency expense can prevent you from needing to borrow money with a credit card. You don't have the time or desire to research stocks to buy. Why you should start investing ASAP. While there are some valid reasons not to buy stocks, the upside potential outweighs the risk for most people. So it's almost always a good idea to invest in stocks, even when the market is at an all-time high. Studies have shown that what's more important than time in the market is an investor's time in the market. I say that all the time. Holding out for the right time to buy stocks can be costly because a large portion of gains comes from a small number of days. Meanwhile, stocks tend to recover from stock market corrections or earning declines of more than 10% in a matter of months. The longer an investor is in the market, the lower the probability of losing money. Equally important is picking the right stocks to buy. As David Gardner, co-founder of the Motley Fool, puts it doesn't matter when you invest if you're investing in great companies. A minority of the stocks accounts for a majority of the market's overall return. That's why it's better to buy stocks in a great company as soon as you can rather than waiting for a better price that might not never come. For most people, the time to buy stocks is right now. People who have money they won't need for a few years should consider investing in stocks since it has the potential of earning the highest returns. Waiting to invest that money is more likely to have a negative impact on an investor's returns than a positive one. That's why the best time to buy shares of a great company is almost always right now. So I want to give my thoughts on this. I agree that the pros greatly outweigh the cons of investing in the stock market. The reasons why I invest is, of course, to build wealth. I have future goals, which one of my goals I was able to achieve. I was trying to purchase a bread route or a bread business franchise, and I was able to put a down payment on that through saving in my brokerage account, and I liquidated my portfolio from Fidelity Investments. That's the trading application or trading app that I use on my phone for buying stocks. So I did that. That helped me with that, and I also have a retirement account, a Roth IRA, that I'm saving towards my retirement with that. So I think that's a great way. It's a great way to beat inflation, like the articles suggest. Yeah, I think it's pretty much no other. You don't get better returns than this, and really anything else, with the exception of real estate. But you can beat the returns on real estate property. But this is just a great way to grow your money and a great way to save. And like they say, if you're not willing to research, it's probably not for you. Investing in the stock market is not for everybody because everybody doesn't have the patience or risk tolerance. I always say do your due diligence or your research before you invest, even if it's just a little bit of research. I mean, you don't have to necessarily go all out with your research, even though it will only help you. But if you don't want to, it's not going to be the worst thing ever. As long as you have a general understanding of the company, you'll do fine. Like simple companies that we use on a daily basis are better, like Johnson and Johnson, Apple, Microsoft, those type of companies. Like Johnson and Johnson, for example, you don't have to do a lot of research on that company. It's a very simple, straightforward company. It's easy to understand, and it's a solid dividend payer that's consistent. So yeah, those are just some of the things, some of the reasons why I invest in the stock market. And yeah, I'm just trying to beat inflation, and I have goals in the future. And another thing is now, like they said, now you have the ability to buy fractional shares. Back when I first started investing, I couldn't buy fractional shares. I was using Robinhood, and you had to wait some time, and that was a pain, having to buy a full share of a company, and I didn't have the money to do that. And I really wanted to own some of the bigger companies out there. But when I finally got it available, I was so thankful for that. And then more and more brokerages started accommodating that into their platforms, the ability to buy fractional shares. Like they said, you could do it with just a dollar or so, or a few dollars. I don't know the exact amount, but it doesn't take a whole lot of money to start investing in the stock market. And that's another thing that I like about it. You can start anyway. You can start small. You just work your way up. But it's a great time to invest right now in 2023, regardless of if the market has gone up quite a bit. It's still a great time, because more often than not, you're going to do well, regardless in the long term, when you invest in the stock market, opposed to if you don't. Because like it says, it gains 10% on average per year. That's average. Sometimes it's less, sometimes it's more. But you're gonna do well. You're gonna do better than people that aren't investing. So I just wanted to do this short video on investing in the stock market in 2023. It's gonna be a great year. It's gonna be full of a lot of great things, a lot of great returns, a lot of great investments. Just do your due diligence, be patient, and keep investing. But I'll talk to y'all later. Thank y'all for watching once again. It's been Future Investing. I love y'all. Peace.